Brad Williams, Frugal Finance. Here's an area that you, as an investor with cash sitting in your brokerage account, need to be aware of. If you look at your brokerage statement, you're going to have what's called a sweep account. And you would make an assumption that the sweep account would take your available cash and put it into a reasonable returning type money market account. No, that doesn't happen. Just FYI, I used to be registered with FINRA. I used to be a stockbroker. Back then, a sweep account would sweep your money into a money market account, an account that would earn a reasonable low-risk return, but not like what the sleazy brokerage accounts call a money account. They call it a sweep account, which earns 0.0000 nothing. I understand they need to make money, but they're just absolutely crooks when it comes to money market accounts. So you need to take a proactive step. And again, they do this on purpose because it takes time for you to open up your account. Then you have to enter this information and you have to physically buy the money market account. If you have 10 grand sitting in your brokerage account, in the sweep account, you're not earning any interest. You thought you were, but you really aren't. So now you have to take the steps, physically buy the money market account. You have to physically buy the 10 grand worth of money market account. And it only takes a couple seconds to do. Then you have to remember to sell it. You're going to have to buy and sell whenever you need those funds. And keep in mind, there's a 1-day, 24-hour turnaround, which again is just more hurdles to make it difficult for you to use sensible investing practices. That being said, what are money market funds? Money market funds are a type of mutual fund that invests in liquid, short-term debt securities, cash and cash equivalents. Money market funds have relatively low risk compared to other mutual funds and most other investments, but historically have had lower returns. Money market funds generally fall into 3 categories: government money market funds, tax-exempt money market funds, also called muni market funds, and prime money market funds. Money market funds are generally structured to cater to different types of investors. Some funds are intended for retail investors and are generally limited to individual human beings. Other money market funds, which typically require high minimum investments, are intended for institutional investors. Important, the rules governing money market funds vary based on the types of money market funds. Before buying shares of a money market fund, you should understand which type of money market funds you're purchasing. Why do people buy money market funds? Many investors use money market funds to store cash or as an alternative to bank savings vehicles. How do I earn money from money market funds? Money market funds pay dividends that generally many shareholders reinvest the dividends into money market funds. That should be automatic. They shouldn't have to be dancing around, having to enter a buy to put your money market in there and then sell. Money market funds have historically had lower returns than other mutual funds. You can also do this. It's not as liquid, but it essentially takes the same thing. You're essentially following the same steps. If you don't need your money immediately, you could set up a laddered approach using Treasury Direct. Go in and you could put in, I just use that $10,000 example. We'll use $2,500 and buy $2,500 this week, $2,500 next week into a 1-month Treasury bill. You're going to get 4.3% right now. The money market accounts are probably paying 4.2%. You don't want to leave anything on the table. You could do that, and you could just roll this over. They have an automatic reinvestment deal. If you need liquidity, you leave 3 grand in your brokerage account, and you can buy and sell that. Then if you need to pay bills off of that, make sure you have the liquidity and check writing ability. And if you have any questions, check out my many videos and just type in Treasury Direct under my playlists within YouTube. And there'll be plenty of videos explaining how that works. How do I buy and sell money market funds? Like all mutual funds, investors buy and sell money market fund shares to the fund itself or through a broker for the fund rather than from other investors on a national securities market. Also, like all mutual funds, money market funds are redeemable on demand. This means that investors can generally sell their shares back to a money market fund on any business day at the net asset value per share. The NAV per share is the per share value of a fund's asset minus its liabilities. Stable NAV. Most money market funds, including money market funds intended for retail investors and government money market funds, seek to keep their NAV stable at $1. This means investors can generally buy and sell shares of these types of money market funds for $1. But they're also going to charge you. It's a modest amount, but again, they're going to try to nickel dime you to death. That's why I suggest taking a look at Treasury Direct, and you don't have a middleman sneaking a 0.1% of your money for essentially doing nothing. You can take care of it yourself. Then you have this floating NAV. Institutional prime and institutional tax-exempt money market funds must float their NAV like other mutual funds to reflect changes in market conditions. This means that although these money market funds still try to keep a fairly constant price, investors may buy or sell shares of these types of money market funds for more or less than $1 per share. How do I pay for my money market fund? As with any business, running a money market fund involves costs. Funds pass along these costs to investors by charging fees. Fees vary from fund to fund. What are the risks of investing in money market funds? For all money market funds, historically, the returns for money market funds have been lower than for other types of mutual funds because the yield for money market funds can be low. There is a risk that inflation will outpace and erode investment returns over time. Moreover, if short-term interest rates are very low, it's possible that fees charged by the fund will exceed the income earned on the fund's investment, in which case fund investors may face losses. Keep that in mind. As with any investment, you should consider the impact of fees on your investment. In addition, money invested in a money market fund is not guaranteed by the FDIC like bank accounts are. There is therefore a risk you may lose some or all of your money invested. The types of investments, as I mentioned, if you're looking at a zero risk investment, well, typically it's government securities. That's why I mentioned Treasury Direct. You buy government securities directly. You can go out to 1 month, 2 month, 3 month, 4 months, 6 months, 5 years, 10 years, 20 years, 30 years without having to deal with the middleman. The middleman in this case would be your brokerage company. And there's hundreds and hundreds of different money market accounts out there. So just be careful, understand the components and what's inside the portfolio. In some cases, you're going to read on the internet, well, we have a 5.4% high yield money market account. More than likely, there's some accounts receivable stuff in there. What I mean by accounts receivable, these brokerage companies will go in and they'll buy credit card debt. They'll use that as a tool to put your money market account into, and it fluctuates. Like anything outside of treasuries, there could be some serious market movement. Again, there's no free lunch. If you're buying a money market account that is a full percent higher than the average, then there's more risk there than you would if you're strictly in US treasuries. For stable NAV money market funds, if a stable NAV money market fund's NAV per share deviates by more than half a cent from $1, fund must reprice its shares to something other than $1. This is known as breaking the buck and could happen when a money market fund is exposed to substantial losses from some of its holdings. For example, 2007, 2008, when Lehman went upside down, the money market account broke. There was such a huge rush of money moving in and out. The money market accounts were unstable, and the Fed had to come in and support the money market account with trillions and trillions of dollars in order to stabilize the market. So now there are some serious rules in regarding to this breaking the buck. So this is known as breaking the buck and could happen when a money market fund is exposed to substantial losses from some of its holdings. If this happens during times of general turbulence in the financial market, it can lead to a run on some money market funds. Although funds very rarely break the buck, if one does, the investor's holdings in the fund could lose value. For floating NAV money market funds, that's with other mutual funds, the value of your floating NAV money market fund shares generally decrease or increase as the money market fund assets decrease or increase in value respectively. If the value of the fund shares decrease, investors' holdings in the fund would lose value. What should I consider before investing in money market funds? Before investing in a mutual fund, you should carefully read the fund's available information, including its prospectus and most recent shareholder report. Consider whether the fund fits into your overall financial situation. Ask questions about anything you don't understand. you're entrusting your money to someone else, you should know where your money's going, who's managing it, and how it's being invested, and how you can get it back. This is all helpful, useful information provided by the SEC. Tons of tools. I have videos on almost all of this stuff, so check out my playlist. Comment if you have any questions regarding money market accounts. Brad Williams, Frugal Finance. Hope that helped. Thanks for watching. See you soon.